Welcome back. This is Patrick Bratalato. We're just going to jump right back into covering more of the balance sheet. In this case, though, we're going to go from Pepsi, which we just did, or PepsiCo, I guess technically, to Chipotle, and cover their balance sheet. In the same way that I did with Pepsi, I just want to split open the assets and then the liabilities and equity, mostly just to fit it on a slide, but also for the conversation. Yeah, to keep it more streamlined in some ways. In general, I want to actually just build off of what we saw with Pepsi. So hopefully we're able to check that one out first, and we'll just jump into that with Chipotle. As I mentioned at the end of the Pepsi discussion, there should be similarities across their balance sheets, but there also should be differences. Again, they are creating a comparative balance sheet, so listing 2 years. Their fiscal years ends exactly on December 31st, 2021. So they're using just the traditional 12 months instead of the 52 weeks that PepsiCo used, although I didn't mention that then. Theirs are also in thousands, not millions, so the dollar amounts are slightly different, but actually not a huge difference in many ways here. So what does Chipotle have here? They're going to be representing their cash and cash equivalents, same as Pepsi, different amount. Chipotle is a smaller company in different ways, but they have cash and cash equivalents. They have accounts receivable, similar to what Pepsi had, and their accounts receivable would be the amounts of revenue they've earned but have not yet collected the cash from the customers. So that represents a future cash inflow they expect from prior sales on account. They have inventory. In their case, the inventory itself would be different, but similar idea. Excuse me, those are the items that they currently have and they are planning to sell. Given that this is mostly perishable food, I'm assuming planning to sell in a very short time period from now. They actually also have the same line, prepaid expenses and other current assets. The dollar amounts are different, but that would be the same thing as we saw with Pepsi. One, the other current assets can include a variety of different asset accounts that get combined together into one line. And then prepaid expenses can be things like prepaid rent or prepaid insurance that Chipotle has paid in advance and has not yet used up. So they remain assets because they get the future benefit from those items going forward. They have income tax receivable. It is not exactly the same as a deferred tax asset, that PepsiCo had. Not to do a deep dive into these, but that's just the opportunity to get a benefit of receiving. I mean, many ways you could think about that. The simplest way to think about that, that's kind of like the expectation of receiving a refund. So the asset representing a present right to a future benefit is that they have to be getting something good out of this in some ways. And so that's the simplest way to think about that is they expect to receive some cash, like a refund from the IRS related to their taxes. And then they have investments. And so we saw with PepsiCo, these were short-term investments. These are also in the current asset account. So these are also short-term. They're listed in a different order. That's okay. These items are usually listed in order of liquidity. So given that these are towards the end of the current asset list, I would argue these are probably with an expectation of being of being able to convert these into cash within a year or so might be realistic, probably not much shorter than that. And combining those line items, those 6 line items, we have our total current assets. Going down, they have leasehold improvements, property and equipment net. Now, that would be all of the property and equipment they have, but actually this is worth noting that the biggest component of this is the leasehold improvements. That would be the way that they've improved and changed the stores that they lease or rent. And so what the asset there represents is the amount of money that Chipotle put into, adding flooring and counters and lighting and all the other aspects inside the stores. But importantly, stores that they don't own, stores that they rent, you don't need legal ownership of an asset to recognize it on your balance sheet. Of course, that's perfectly fine if you have legal ownership. But in this case, the accounting definition of an asset is that you have the opportunity, an opportunity for the future benefits. It doesn't require that you legally own every single asset you list on your balance sheet. So property and equipment is traditional property, plant, and equipment, as we saw with Pepsi and many other companies. Leasehold improvements would be an asset for companies that have, one, leased property, but then two, spent money in making those properties nicer for their use, for their customers and their kitchens, whatever else. Long-term investments, similar to the investments listed in the current section, except the argument is because these are listed in non-current assets or not a part of the current assets, that these are investments that Chipotle has made. The details would be provided in the footnotes, not necessarily here, but investments that they've made with the expectation of holding on to for beyond 1 year. So think about this as like in your retirement portfolio, or if you have a brokerage account or something that you're not actively trading, but you just make the investment with the intent to hold it for 5 years or 10 years or whatever else. Restricted cash. That is actual cash. It just usually is that it's restricted for some unique thing. And it's separately reported on the balance sheet just to show that it's not cash that Chipotle could do whatever it wanted with. These could be related to lawsuits. They could be related to employee issues or pension plans and stuff like that. So just the general idea, it's like cash that they actually have, but there's already a expected use of it, and it's not just cash they could spend on whatever they want. All right, operating lease assets. This goes with the leasehold improvements. That is actually, so the accounting rules changed relatively recently, but now, even when companies lease stores, longer term leases, so beyond 1 year, we have a method, which we won't cover now, but I'll give the general idea of estimating the value of those stores that they lease. In this case, they're restaurants, not items or property that they own, but because the future benefit of the store or the restaurant is more in terms of the revenue the store generates, there isn't really that big of a difference between leasing something on like a 10 or 15-year lease and owning it. And as a result, we actually represent like an estimate of what those stores would be worth if Chipotle owned them, and bring that as an asset on Chipotle's balance sheet. So Chipotle leases a significant amount of their restaurants. Those are not physical locations that they own. However, given that gives them the rights to operate those restaurants however they want, generate revenue, etc., that is still meeting the definition of an asset and is reflected on their balance sheet as operating lease assets. Then they have other assets, which would be a collection of things that are just non-current, and goodwill. We talked about goodwill with PepsiCo. I'll just quickly give the summary again. What does that mean if a company has goodwill? They have previously acquired a company. In this case, we know the acquisition came before December 31st, 2021, because they had goodwill then and it stayed the same over time. Previously acquired a company and paid a premium over the net assets they obtained in that acquisition. Not necessarily good or bad, beyond the scope of this discussion, but all of those combined give us the assets for Chipotle. The items that they have, not necessarily what they legally own, they have, and they have the right to control the benefits from. All right, let's switch over to the liability and equity side of their balance sheet. First, with the liabilities. Accounts payable. Similar to PepsiCo, this is the amount they owe to suppliers, and almost surely in both cases, accounts payable can be for a variety of things, but I'm certain in both cases that part of this, if not most or all of it, is going to be the amounts they owe to suppliers for the ingredients and the food that they both use to make their products. I realize that the specific ingredients they're buying from and the specific entities they're buying the food and ingredients from is going to differ, but it's really accounts payable, amounts companies owe to their suppliers for items that they've received, which they're going to use in their business, but they have not yet paid the suppliers for. So accounts payable represents a future outflow of cash. Accrued payroll and benefits, well, that would be another liability. And we use the term accrued to represent something that's been incurred as an expense and not yet paid. That also could be, as I used in my prior lesson, referred to as wages payable. Technically, accrued payroll and benefits is probably a more specific term, but the idea of wages payable is the same thing. So I'm going to go back to that right now on this introductory level. It's the amount that the employees have themselves worked, and so Chipotle owes the employees. The employees time is an expense for Chipotle, but Chipotle has not yet paid the employees, so it has to represent a liability related to the amounts that it still owes its employees for the works the employees have done. Accrued liabilities is a good general account, which just means a whole host of different things. So if they have utilities payable, if they have any other form of bills, if they have rent payable or something like that, those could go into something like accrued liabilities, representing an obligation to make good on something that they have not yet paid. Unearned revenue. All right, now this one didn't come up in PepsiCo, and it's worth addressing here because it's one of the key things to think about of how we deal with accrual and cash accounting. Unearned revenue represents revenue that they have, cash they've collected from customers for which Chipotle has not yet provided the good or service. In this case, the customer hasn't gotten their meal yet. And there are two things that give rise to this for Chipotle. One, like the classic example of this is gift cards. So if you go and buy a $20 gift card, but you haven't yet redeemed it at Chipotle, that's going to be cash that they receive. But it's also a liability called unearned revenue because they owe you. They have your cash of $20 after you buy a $20 gift card, but they still owe you the meal or the two meals or whatever it is associated with that $20 gift card. And so we represent that with a liability called unearned revenue on companies' balance sheets. The other thing it can be and is for Chipotle is rewards programs. And so that would represent the obligation that the company has for rewards that the customer has already earned but not yet redeemed. And really, you can think about those as the same thing. In both cases, the company, Chipotle here, has an obligation to the customer, either because the customer has previously given cash for a gift card or because the customer has previously earned rewards, which gets them, in both cases, whether it's a gift card or a rewards program, rewards that the customer has earned, the opportunity to get food without giving Chipotle additional cash. So a liability here. Current operating lease liabilities. Well, if we had the balance sheet represent the asset side of this, those leases aren't free, right? So we'd have to represent on the liability side the obligation. So basically the asset is like an estimate of the value of those stores. And then the liability side is going to be a representation of like how much Chipotle owes. The current operating lease liabilities would be the portion that Chipotle owes for effectively their leases, their rent in the next year. And I'm going to jump down for a second here to make sense. Long-term operating lease liabilities, that's the rest of it. So this would be actually very similar to, it's not literally legally a mortgage, but these work the same way. The amount they owe in the next year, say they have 15-year leases on their restaurants. The amount they owe in the next year, say they just signed them all, which is actually not the case. They're ongoing for them, but let me make it simple. If they sign a whole bunch of 15-year leases, the amount owed in the next year would be the current operating lease liabilities. And the amounts owed in years 2 through 15 would be the long-term operating lease liabilities. And collectively, if I combine those two accounts, the $236 million with the $3.4 billion, that would be the total amount that they owe related to all of the stores that they've leased from other entities. I skipped over it, but just to be clear, they also have a subtotal for total current liabilities. That just adds up the previous 5 lines. Long-term operating lease liabilities is definitely a non-current liability, but I just combined them together for the discussion. They have deferred income tax liabilities. Those are simply the amounts that they will owe to the IRS in the future. That's the basic idea there. And other liabilities, which would be other non-current liabilities, even though it's not labeled, would be just other amounts they owe to different entities, et cetera, that are individually not that important to report on their own, but still have to be reported as a liability on their balance sheet. Put all that together, we have roughly $4.5 billion worth of liabilities for Chipotle in this period. All right, let's jump to equity. Similar thing, I want to kind of de-emphasize the particular accounts, although I kind of like Chipotle here because it's less stuff going on. They have common stock, additional paid-in capital. You can combine them. They have treasury stock. It's a negative number. It doesn't mean anything bad. What that means is they've repurchased their shares. What that generally means, is that they've repurchased shares over time. They have the accumulated other comprehensive loss, which is also called accumulated other comprehensive income if it was positive. And that's just a series of unique adjustments that we have to make sure everything works out. And then retained earnings, much like Pepsi, which is the amount of money that Chipotle has earned and not yet distributed to its investors. Combining all of that, they've got around $2 billion of shareholders' equity. They've got $4.5 billion of liabilities, and those balance to equal the roughly 6.9 of total liabilities and shareholders' equity, which is exactly the same as the amount of total assets. That's Chipotle's balance sheet, similar to but different from Pepsi's. We work through the asset side, the liability, and the shareholders' equity side. Assets, the things that they have rights to, future benefits, liabilities, the expected future sacrifices that they're going to have, equity, the ownership portion of it from the perspective of the Chipotle shareholders or Pepsi shareholders, et cetera. And that is our discussion of the balance sheet. There's a lot more deeper, we can do a deeper dive on some of these, where they come about, how do we analyze them, how do we use the footnotes to explore more details. But at a general level, what we walk through in these two discussions is just how do we understand what's presented in a descriptive way, what's presented on a balance sheet, and what are some terms to get comfortable with. Not a comment about good or bad, but that is, once we have an understanding of the terms, we can absolutely use that to launch into conversations in, are they improving or deteriorating, and why, and what things are moving together, et cetera. But the first step right now, and hopefully you have a chance to kind of do this with a company that you yourself are interested in, just work through and try to understand what each line item is and how it relates to the company itself. So with that, one more down, 10,000 more to go. Take care. We'll be doing the other financial statements very soon.